The moment we've been waiting for has arrived, and keep your eye on this, because the timeline matters. Asian markets opened just hours ago, and the verdict is in. The banks have failed. On Friday, they hurled billions of dollars worth of paper contracts at the market in a desperate attempt to smash silver below that critical $65 level, trying to break the psychological momentum before the week even began. They failed. As the bells rang in Tokyo and Sydney this morning, silver didn't crash. Instead, it opened strong, gapping up, and it held firm above $67. And don't treat this like just a price move. Keep your eye on what it signals. A declaration of war. It means that Friday's smash was the last bullet in the chamber for the bullion banks. They're out of ammunition. The market called their bluff. We're not speculating about a squeeze anymore. We're watching the opening shots of a kinetic financial event that could end the dominance of the COMEX pricing mechanism forever. And if you want to understand why this Monday open is catastrophic for JP Morgan and the swap dealers, you have to look straight at margin pressure and collateral math, because in the futures world, every tick hurts. COMEX silver futures are standardized contracts, 5,000 troy ounces per contract. So when price moves against a big short, the collateral demand is not a metaphor, it's a mechanical squeeze. Here's the trap, and keep your eye on the trap. These banks are holding massive short positions bets that the price will fall. Every penny the price rises above their entry point costs them tens of millions of dollars in collateral. By opening above $67, the market shoved them into a zone of maximum pain. They're now underwater. Normally, they'd double down, sell more paper to force the price lower, but they can't. The liquidity isn't there. If they try to sell more, they risk getting overrun by buyers. If they try to buy to cover, they ignite the very inferno they fear, driving the price towards $75 instantly. They're paralyzed, trapped in a burning building with no exits. So understand this. The stability you see on the chart right now isn't peace. It's the calm before the margin call. And while the banks stare at paper losses, the real economy is waking up to a physical crisis. Keep your eye on the word physical, because that's where regimes break. Elon Musk and the procurement teams at Tesla are watching this open with terror. Tesla doesn't consume paper. It consumes metal. A standard electric vehicle uses up to 50 grams of silver, and the new Cybertruck uses even more. And here's the public context that makes this panic make sense. Industry estimates widely place silver use in EVs in roughly the 25-50 gram range, depending on model and electronics. Meaning, up to 50 grams isn't a throwaway line. It's an input cost that scales with every production line. Now zoom in. With price holding at record highs and inventories at record lows, tech giants are realizing the just-in-time delivery model is broken. We're receiving reports of off-market private deals being struck between tech companies and miners, bypassing COMEX entirely. This shadow demand is removing metal from the market before it even reaches the vaults. And keep your eye on this escalation. When Elon Musk realizes he can't get silver for solar panels, he won't just buy silver, he might buy the mines. That kind of industrial panic is the fuel that takes us from $70 to $100. Because the engine driving this squeeze isn't sitting on Wall Street, it's sitting 7,000 miles away. The Shanghai Gold Exchange SGE opened with a roar. The premium for silver in China has expanded again, meaning silver is worth significantly more in Shanghai than in New York or London. That price gap creates an irresistible gravitational pull. Every available bar in the West gets loaded onto ships and planes to be sold in the East. Arbitrage is not ideology, it's physics plus logistics, and the SGE's benchmark infrastructure is real, publicly visible plumbing in the system. And that arbitrage, keep your eye on the drain, is bleeding the LBMA vault system. The LBMA publishes monthly London vault holdings for precious metals, including silver, precisely because London is a central node for physical settlement in the OTC market. When metal leaves, the market feels it. The West is trying to suppress the price to save the dollar, while the East uses that suppressed price to drain strategic resources from the West. The greatest wealth transfer in history, and it's happening in plain sight. Now, for 20 years, high-frequency trading algorithms have helped control this market, programs designed to sell when price hits resistance. But today, the machines are confused. They're firing sell orders, and the price isn't dropping. That's algorithmic failure. And keep your eye on what happens next. When the AI realizes selling isn't working, it's programmed to switch sides. It flips from net short to net long. When that switch happens, likely later today or tomorrow, you'll see a buying frenzy that's purely automated. The same machines that kept the price down for a decade become the machines that drive it to the moon. We are watching the machine turn against its masters. And yes, HFT and algorithmic trading really do operate at extreme speed and scale, which is why when flow dynamics flip, the move can look like a step change, not a stroll. Now look at your screen. Silver at $67. But try to buy it. Call a dealer, Go to a website, you'll find the real price is much higher. Premiums are exploding, delays are mounting. This disconnect paper price versus physical availability is the hallmark of a dying currency regime. Publicly, the spot reference price is not the same thing as the delivered retail price, and premiums can widen sharply when inventories tighten and fabrication capacity bottlenecks. The paper market claims there is plenty of silver. The physical market says there is none. This divergence cannot last. Eventually, the paper market must break. And when it breaks, the price won't rise gradually, it will reset. We are approaching a moment where the exchange will likely declare force majeure and settle contracts in cash because they simply do not have the metal to deliver. If you're holding a paper contract on Monday morning, you don't own silver, you own a lawsuit. And keep your eye on the legal mechanics. Force majeure is a real contractual concept used across commodity supply chains when performance becomes impossible or radically different from what was agreed. Technically, we are setting up for a gamma squeeze later this week. The options market is loaded with call options at the $70 and $75 strikes. As price inches closer to those levels, the banks who sold those options are legally required to hedge their risk by buying futures forced buying that acts like a magnet pulling price higher. Positive feedback loop. The higher it goes, the more they must buy. The more they buy, the higher it goes. Friday's close was the spark, Monday's open is the fuel. $70 is the match. Once we cross that line, the explosion is mathematical and inevitable. And gamma squeezes aren't folklore, they're a known options hedging dynamic, publicly explained in mainstream market education. Now watch the psychology, keep your eye on sentiment. For years, silver investors were battered and bruised. They sold at the first sign of a rally. But look at today. No one is selling. The silver squeeze movement has evolved from niche internet theory into a global investment thesis. FOMO is setting in. Retail investors who watched Bitcoin go to the moon are hunting the next big thing. They see silver breaking out. They see the banks trapped. And when the retail herd arrives, and they are arriving now, the liquidity of the silver market is too small to handle them. It's like trying to push the water of Niagara Falls through a garden hose. The pressure bursts the pipe. And we have to speak plainly about what this means for the banking system. If silver goes to $100, several major financial institutions are technically insolvent. Their liabilities on the short side exceed their Tier 1 capital. That's why they're fighting so hard. That's why the media is silent. They are fighting for their lives. If JP Morgan loses control of silver, contagion spreads to gold, then to the bond market, and finally to the U.S. dollar itself. Silver is the linchpin, the small gear that turns the big gear. By holding the line at $67 this morning, the market is effectively holding a knife to the throat of the banking cartel. This isn't just about money. It's about power. Now widen the geopolitical lens, keep your eye on the currency map. The BRICS nations Brazil, Russia, India, China, South Africa are actively moving away from the dollar. They are building a new trade settlement system backed by commodities. Silver is a key component of this. By accumulating physical silver, they are bulletproofing their economies against the collapse of the fiat dollar. Monday's strong open confirms the East is supporting the price, putting a floor under the market. They won't let it crash because they own the physical asset. The West is short, the East is long, and in a resource war, the side with the resources always wins. Public reporting and analysis do show accelerating de-dollarization efforts via local currency settlement and alternative payment rails. Whatever you think of the politics, the direction of travel is visible. Now track the shortage down the chain, keep your eye on the supply ladder. It started at the mines, then it hit the refiners. Now it's hitting the mints. The U.S. Mint is already on allocation. Private mints are backlogged. Soon it will hit the factories. When Samsung can't get silver paste for electronics, they will panic. They will bid the price up to whatever is necessary. Industrial demand is price inelastic. They must buy regardless of price. They cannot build an iPhone without it. That inelastic demand is the ultimate safety net for silver investors. The price has to go high enough to force people to sell their jewelry just to keep factories running. That price is not $67. It is likely over $200. Now notice what is not on the news today. CNBC is talking about tech stocks. Bloomberg is talking about interest rates. No one is talking about silver hitting an all-time high. The silence is deliberate. They don't want to alert the public. They want to keep you in the dark while insiders position themselves. But the chart doesn't lie. The volume doesn't lie. The silence of the media is the loudest confirmation this is the real deal. They only ignore what they fear. And right now, they fear a run on silver more than anything else. Traders need to be prepared for the exchange to cheat. If the price gaps to $80 this week, do not be surprised if COMEX halts trading. They will cite extreme volatility. They will change margin requirements. They will try to force liquidation. We saw it with nickel. We saw it with the Hunt brothers. But this time is different. The physical market is too strong. And keep your eye on the precedent, because it's public record. LME nickel trading in March 2022 saw suspensions and controversial trade cancellations during extreme volatility, and regulators later dissected what went wrong. And the Hunt brothers episode Silver Thursday is also a real historical warning of rule changes and forced deleveraging when an exchange decides the system is at risk. Because if they close the paper market, the real trading moves to the street. It moves to Shanghai. It moves to private peer-to-peer networks. Closing the casino doesn't stop the game. It just proves the house is broke. So what happens next? If we hold $67 through the Monday session, the next resistance is nothing. There is no historical resistance above this level. We are in price discovery mode. The sky's the limit. Technical analysts project a swift move to $75, followed by consolidation, and then a violent run to $100. At $100, hysteria kicks in. That's when your taxi driver starts talking about silver, when your grandmother asks how to buy coins. We are not there yet. We are in the smart money phase. The public mania phase is still to come, and that is where the real gains are made. Monday has arrived. The disaster did not happen. The price held. The thesis is confirmed. The squeeze is on. If you're sitting on the sidelines waiting for a dip, you might be waiting forever. The train has left the station. The doors are closing. The transfer of wealth is happening right now, real time, on the screen in front of you. The banks bet against reality, and reality is winning. Do not let them gaslight you. Do not let them shake you out. Hold your position, watch the gap, and prepare for the ride of a lifetime.